most people are aware you have interest rate terms of the loan are also vary. Could be the time in the loan, it'd be 30 years, 15 years, or 20 years, the amount that is financed, and then what the costs are of the loan. Typically, people that is investors get a 25% or more down payment. That's what they put down. They get a loan for 75% or less, and they use their income as collateral. The percent of equity affects how fast that the loan pays off, the term of the loan, and the rate of the loan. So these are two different loans. But the top ones are at 6.5%. You can see at year one, if you have a 30-year loan at 6.5%, you make a return on your invested capital of $100,000 to pay off about $3,400. And at year 10, you're paying off $6,000, which is 6% of that $100,000. At an 8.5% rate, those numbers are a little bit lower. 30 years, it's 2.3. At year 10, you're paying off $4,900 of that. And so that's the return on your $100,000 investment. To 15-year, obviously your returns are higher. You're paying yourself back. And that means more is going towards the pay down, the equity on the loan. So you're paying that loan down faster. So those are the numbers that are there. Well, the lower the interest rate, obviously, the higher return you get. Drawn out $400,000 loan, $100,000 down 25%. Mortgage at $300,000 and at 6.5%, which is the blue line, and 8.5% interest rate. So you can see the loan pay down. The blue line, lower the interest rate, it pays down sooner, and the red line, the higher the interest rate, it doesn't pay down as fast. It pays off more towards the end. 15-year accelerates the same amount of time. That is 30 years, but it pays off in 15. So you have that, you've gained that $300,000 in equity in the property over 15 years rather than the 30. Leverage also magnifies the returns. If you put $200,000 down on a $200,000 property, and if you have an increase of $10,000 in value, your return on your investment of $200,000, which is 100% down, paid for the property in total, is 5%. If you have $100,000 down, 50% loan, 50% down, that $10,000 increase in value means that you have a 10% return on your $100,000 invested. With $50,000 down payment or $150,000 in the loan, your payment is at 25%, but your return on investment with a $10,000 increase is 20% of that $50,000. The less money you put down, obviously, the higher return on the less money that you put down. Appreciation, loan pay down, these things grow. The appreciation of the property goes up. That is, the value of the property goes up. And the space in the middle between those lines is the amount of equity that you're growing. So you're growing in both directions, paying down the loan, which is a red line, and the property is appreciating at the same time. So it's going up.